Welcome to Willow Oak Asset Management's third quarter review. I'm Stephen Keel, the president of Willow Oak and the portfolio manager for Arquitos Capital. Willow Oak Asset Management partners with alternative asset managers to help them reach their goals. We offer operational support, strategic planning, value-added investor relations, single point coordination for third-party providers, and infrastructure that ensures scalability. Having launched, managed, and operated both internal and external hedge funds, Willow Oak seeks opportunities to partner with unique funds at various stages of development, meeting the operational and strategic needs of our partners. So we are excited today to welcome Sri Viswanathan, who is our latest manager that's joined us from SVN Capital. We also have David Waters and Keith Smith. So let me do a brief intro of everyone, and then we can kind of get into the questions. For Sri is the manager of SVN Capital. That's where he manages a global portfolio of compounders in special situations. The hallmarks of companies that attract his attention are exceptional management, competitive strength, and attractive reinvestment opportunities. We have David Waters, who's been with us for since the beginning of Willow Oak from Alluvial Fund and Alluvial Capital, where he runs both a hedge fund and managed accounts. Dave generally works in the microcap space, looking for complicated, underestimated, sometimes even stigmatized companies and businesses across industry sectors and geographies. Keith Smith. Keith is with Bonhoeffer Fund. He looks for growing businesses with multiple ways to win. He uses his expertise in corporate valuation to identify these strong companies in disrupted industries, misunderstood markets, and emerging markets. So I appreciate each of you joining us today. First question goes to our newest manager, Sri, and we'd like to kind of have a discussion amongst everyone here. Look, Q3 just ended. This possibly might have been the longest year of our lives as we're getting into Q4. And, Sri, how was Q3 for you in terms of an analyst, the businesses that you're looking at, things on the watch list, and perhaps even things in the current portfolio? What are your observations there, and what do you think about the upcoming few months?
Sure. First of all, Steve, thank you for giving me this opportunity. I think this is a fantastic partnership that I hope will continue to develop well for all of us over time. And thanks to Keith, first of all, for introducing me to your partner, Jessica Greer, sometime last year, and delighted to be on this platform. Dave, I've read a lot of your letters, and Jeff Gannon is another manager that I've followed for a number of years. In fact, he is the one guy that I have followed for more than a decade now. Delighted to be on the same platform as you guys. So thanks a lot. To answer your question, Steve, about Q3, perhaps a quick overview of my strategy would help in describing what I have seen in Q3. My approach to investing is fairly simple, straightforward. Invest in businesses that I can understand, which eliminates a good chunk of a number of different sectors and industries. Partner up with companies that have fantastic return opportunities, not only fantastic returns, but ability to reinvest that return, run by good quality management teams with skin in the game, available at a reasonable valuation. So those are the four yardsticks that I measure every single opportunity. I currently have 12 investments in the portfolio. 8 of them are in the U.S., or at least trades in the U.S. The rest are outside, mostly more recently Eastern Europe. Performance in Q3, when I look at the year-to-date numbers and the portfolio itself, it's essentially a continuation of what's happened in Q2, actually. With the deployment of stimulus, monetary and fiscal across the world, companies, businesses that are in my portfolio and the ones that I'm interested in have continued to essentially take the baton and run with it. They've seen interest rates continue to remain low. That's facilitated many of these businesses regroup their capital structure a little bit. But overall, it's been a continuation of what we saw in Q2. And later on, I'm sure in this conversation, we'll delve into specific sectors that worked and didn't work.
Sure. And I appreciate that introduction and an overview of the strategy. As you've been the latest manager, we're thrilled to have you join the platform, both at the Willow Oak level and amongst the portfolio managers here. Unfortunately, Jeff and Andrew Kuhn from Focus Compounding weren't able to be with us, but they share that excitement, and it's nice to be able to have this network, this formal network of managers to talk about research and approach and philosophy. And it will take me a couple tries to get your name correct. So it's Viswanathan. Sri Viswanathan. We've generally, we had Keith Smith, David Waters, Jeff Gannon, Andrew Kuhn. So simple names. So we're expanding and diversifying here by having a name that will take me a couple times to catch here. So great to welcome Sri Viswanathan, and going over to Dave, same question. What's it looking like for you? I'd love to hear your thoughts.
Sure, I'd say that, and this is no surprise to anyone, but the big macro questions of the day still dominate the market. I mean, is COVID going away? Will there be another massive stimulus bill? Will interest rates, have they seen a bottom? And I found that there's been a gigantic divergence in how the market views companies in general, and including companies in my portfolio. It seems like anything or even just adjacent to the digital economy, the online world, is just gangbusters. Everything's on fire. The market can't get enough of companies like that. On the other hand, anything that's industrial or leveraged real estate or is in the financial industry with lending or whatever is untouchable. And the market, I find, tends to overreact and put a little bit too much emphasis on the short term for all companies. And so I think that if we get a bit more clarity going forward, we could see a return to the mean in certain industries like that. And maybe that means good things for anything except Zoom, Apple, Microsoft, Netflix, etc. I'm not going to sit here and say it'll happen tomorrow, but I think it'll come. Interestingly, though, I'm not new here. People probably know a bit about my strategy, but I tend to focus on companies that are very, very much off the radar of the market, and especially and sometimes exchanges and geographies that don't get a lot of attention. And so sometimes my portfolio just acts as if it doesn't know what's going on in the rest of the market, for better or for worse. Maybe the NASDAQ is on fire, but maybe there's pessimism in the Italian telecom market, and that's weighing down, or maybe it's the opposite. Maybe Texas real estate is doing great, even as the New York financial sector is in trouble. And so it's nice to kind of hang out in those names now and then and let the troubles of the world go by and not be affected by them too much. But sometimes, on the other hand, when the market's in massive rally mode, I'm sitting outside with my hands in the window saying, please let me in. But it was a successful quarter. I'm looking forward to getting more reports from companies coming up in the third quarter, especially companies that receive PPP or CARES Act funds. It's interesting, especially for small companies. Those are incredibly material, and it'll be interesting to see how much of a cash cushion that provided, or how it smoothed the worst of the lockdowns in the trough over the summer, which we're hopefully through.
Yeah, absolutely. Keith?
Yeah, so Q3, as Dave and Sri had mentioned, is a very interesting quarter. As Dave said, what's happened is, in both Sri, is we've had a continued recovery with the internet names basically continuing to be, and the new economy names continuing to outperform other names. Pretty much all of the stuff that I focus on is outside of that area. So what's actually happened, though, is we've had some nice recoveries, though. A big portion of our portfolio is in what we describe as sort of compound mispricings. A lot of preferred stocks in Korea, and those have been some of the best performers, especially some that have been involved in special situations like holding company transactions and such. So there's been a lot of interesting special situation stuff going on overseas. There continues to be a lag in certain markets. The one that I've observed has been South Africa, and I think you can see over time what's happening with COVID. China recovered first, and then you have the United States, and then you're going to see Europe, and then you're going to see places like South Africa and the other emerging markets. So I think what you're going to see over time is you'll see this movement. Now, what's really helped both China and the U.S. has been the large tech exposure that both of them have had in their indices or their groups of companies. So those ones clearly have gone with the vanguard. But even if you look at an industry like auto dealerships, the auto dealerships you can see in China are up, probably some of the better ones are up 150% year to date. The U.S. ones are flat. The British ones are probably down 20%, but the ones in South Africa are down 50%. That just sort of illustrates, I think, where we are now in terms of this COVID recovery. And going forward, as countries learn how to deal with COVID, and we as a world learn how to deal with COVID, I would expect the economics of those to sort of catch some of the lagging countries to catch up. And the same thing, I think, with companies in the U.S., the smaller companies will catch up with the larger companies as COVID becomes something that we can really deal with. I think we've done a great job so far in terms of being able to deal with it, but I'm anticipating going forward it's even going to be better, and we'll actually be able to get back to some semblance of normalcy probably sometime next year. So
yeah, and you bring up kind of leading to the next question about opportunities and challenges with smaller companies. Before we do that, I will repeat my friend Jeremy Deal, who's on the board of the parent company of Willow Oak, has had a approach called survivors and thrivers. And so for me at Arquitos, the way I like that approach, you're looking for companies that not only have survived this crisis, but that also can thrive from it. And what Q3 has done is begun to show operationally, forget about the stock prices. We have to do that at this point because none of that is baked in as of yet. But when you look at the operational results that are coming due now and will be coming due soon for the the smaller companies, we can start to differentiate those who are merely surviving and those who have survived and are thriving, who are able to take market share from competitors, perhaps take over failing competitors, who still have pricing power and competitive advantages during this time period. And I think Q3 is a much better, will give a much better picture of that, and has begun to already give a much better picture than Q2 did, and certainly kind of the end of Q1, which wasn't very helpful with some of those results since it was the very beginning of COVID. So I look forward to seeing that in the Q3 results, and then also looking into Q4. And those are the companies I'd like to be with right now, those who have strong capital allocation policies and things that have happened here recently. It starts to differentiate and highlight those capital allocation, strong capital allocator companies that we might not have otherwise seen before, and then see what decisions they're making and see if they can survive or thrive. So I'm always happy to steal a good idea, and I'm stealing this one from Jeremy and give him full credit for it. And that's kind of the benefit of having, I think, this network here as well. Is I like that approach, and those are the things that are on my watch list that I've even started to open up a few positions in as well. So to Keith's kind of leading to the next question here, and I think this one is always a good one for Dave to start off on. What is it looking like right now with smaller companies? What are the challenges? You mentioned the PPP loans, which is an opportunity in the balance sheet for some of these companies as well.
Yeah, I think it comes down to balance sheets first and foremost. Yeah, you're right that any environment in which a company is severely challenged is also an opportunity to undergo necessary change and drive optimization, which is easy to push off into the future when times are good. And so companies that came into this year with a strong balance sheet, with cash reserves, with lines of credit, without overwhelming debt, they have the ability to do that, especially now that their balance sheets have sort of been underwritten by the federal government. But companies that didn't have that, they were already maxed out in terms of leverage and already, or just had the bad luck to have done a major acquisition at the end of last year or something and pushed a little bit. Well, yeah, they're struggling a little bit. Their focus is on maximizing current cash flow when their better situated competitors might be actually making the good investments that will take them into the next year and have them set up very, very well. And I think that's especially a problem for smaller companies, which tend to have thinner resources, which tend to pay more for their debt, which tend to have leaders which aren't necessarily as experienced or as connected in the industry as large caps and mega caps will. And so that's always a concern with small companies. And at this point, a lot of the sorting out has been accomplished. We've seen a few companies crash and burn and likely not recover. But as you said, the ones that have succeeded in looking to the future, taking care of the current needs, but thinking, all right, we're in the middle of this, but what can we be doing today to make money 5 years from now? It'll take maybe 5 years sometimes for the market to fully appreciate that, but it won't be long before we see the first of those fruits. And so I'm waiting for that.
Yeah, absolutely. Keith?
Yeah, I mean, I agree with Dave there. I mean, I think some of the small, we invest in relatively small businesses too. If you look at the portfolio, we have some relatively large ones, but a lot of small ones. I think where the small ones can really compete well are in very niche areas. I mean, some areas where the market is just not big enough for a big guy to really make a difference from his particular balance sheet perspective. Another thing that we've been looking at in the portfolio is we've been doing taking a look at disruption. How's it going to affect our companies? But another concept I think that's important in evaluating businesses is something that described as it's probably another name for it, but someone else call it, but basically described as velocity. How fast are you basically for your product or service selling to various customers? There's different ways to measure that in distributors and in retailers. You can measure it by inventory turns, because that's a product that you're selling. In software companies, it's recurring revenue, and in transaction processing, it's basically transactions or marketplaces. So I think looking at those kind of metrics, more of the moving metrics, what I've started to do, which I think is an important aspect for looking at all businesses. Now, these have come to full and they've really developed more in these internet businesses, because that is where these things are key to their revenue model. But I think they're really applicable to all kinds of businesses. And looking at it on a relative basis, for example, for an auto dealership, looking at inventory turns on a relative basis becomes a very interesting measure of not only how they're doing with working capital, but it also becomes a competitive thing, because what that really measures is how fast is the company good at matching people to cars, which is sort of like what their mission is. So in essence, and that follows through in terms of like, okay, how does this match up to happiness? So there's a correlation between all this stuff, but I think looking and focusing on these velocity metrics, or basically what's driving the growth or the change, is a key aspect I think that I've been focusing more on since the beginning of this year, is going through this crisis. And what's really led me there was looking at these internet businesses and then applying those same metrics to more bricks and mortar or normal types of businesses. So I think It's an interesting aspect of what's really going on here from a theme perspective.
Yeah. Shri, I heard your introduction, and it'd be kind of interesting to see how, what is the kind of typical market cap of the companies you're looking at? And, do you have any observations here about some of the potential opportunities or challenges here?
Sure. The type of businesses that I'm interested in are definitely higher quality. We can define quality in a variety of different ways. But size-wise, the structure of this portfolio it provides me the ability to go to any size that I find interesting from an investment standpoint. So, in fact, the median market cap of the portfolio is approximately 20 billion. Definitely a little bigger than a few of your portfolios. Before I answer your question specifically about the opportunity set, I thought it was kind of an interesting article to bring up. Economist magazine ran this article not too long ago, highlighted a particular book called Varieties of Capitalism. It sort of Western world into two different buckets: liberal capital markets, coordinated capital markets. Liberals are the US, Canada, UK. Coordinated is primarily Eastern Europe, Nordic countries. The book goes on to talk about the different types of approaches countries take. And this particular article, they brought in China into the bucket as the third option. Talked about how each one of these countries in these different buckets have handled COVID and the impact on their local economies. I'll distribute it to you all later. But the fascinating aspect is it goes on to describe how difficult it can be living in this liberal market, meaning US, UK, Canada, but talks about how it can be risky and scary, but its failures no doubt cause suffering, but the rewards when things go well can be immense. So there is some silver lining in what we are going through as a country and what we as investment managers go through looking at individual investment opportunities.
Yeah.
To answer your specific question about the investment opportunity set, I obviously, it's a much bigger sized portfolio. They're not necessarily taking on PPP kind of loans, but I have seen specific opportunity sets in, say, Eastern Europe pop up, both as a result of COVID and as a result of ongoing development in those regions. Specifically, I'm talking about Poland. I do have a portfolio name in the country at this point. We'll cover the details later. But the opportunity set is somewhat varying, just given the fact that the type of companies I'm looking at slightly different from what Keith and David.
Yeah, but that, that goes into the question, kind of the emerging markets or other geographical areas. And I know it sounds like Sri, you're looking in that area. I know Keith and Dave look there as well. Dave, Sri mentioned Poland, Eastern Europe. Any thoughts or any comments about places you're looking now that maybe you were not looking at in the past?
Yeah, recently I
Want me to
have
go?
been finding some intriguing stuff in Poland. It's a growing economy. It's an economy that full of entrepreneurs and really, really brilliant people. The question, though, of course, is politics. The governments in smaller nations with a shorter history of Western style democracy are not quite as stable as we would like them to be. And you have to be willing to wake up and see your portfolio down 10% or 15% just based on a certain political party um, rattling its saber or making noise in some way. And if you can handle that, I think it's an excellent place to look for the medium term or the longer term. So places like that are fun to look. I love to look in Scandinavia, other markets that are, again, excellent in terms of accounting standards and investor protection and contract law, but don't get a lot of attention from American investors for whatever reason. So places like that are really, really intriguing. And I think, and I'll see if Keith has more to say about this, but I know Keith likes to talk about these economies that are transitioning to an economy and a model that's more friendly toward shareholders, more friendly toward investors, and the giant change in valuation that companies can get as they transition from a model in history that's less accommodating to shareholders and companies to one that is more. Keith, anything to say about that?
Yeah, no, exactly, there. I mean, I think there's some real interesting situations going on here, and there's some nice long-term trends. I mean, one of the things that we really like to look for are companies that where the trend is really heading in that direction. You've got a country like the United States, probably the UK, where the stuff's established. You can find some interesting values there. The corporate governance bump is probably going to be more on a company by company area. But if you go into places like Korea, we've got a good amount there. And then in other places that are moving in the right direction, South Africa is another one where it's sort of, you know, they're moving in the right direction. They were moving in the wrong direction before. Poland's another one. Another key aspect of some of these markets, as David mentioned, is there is some volatility in the fact that you have foreign capital flows moving in and out of the country. So most of these countries don't have enough capital within their countries to support the capital markets. So they are dependent upon foreigners' flows, which is an additional risk that's there. But if you've got a long-term perspective, you can actually take advantage of situations where foreign investors may pull out. What's incredible to me is there actually is some markets that are still difficult for U.S. investors, especially smaller investors, to get invested in places like Korea. Korea, there's large institutions that can invest there, but their size constraint prevents them from looking at sort of mid-size, what I'd say are mid-sized Korean companies, maybe probably large by Korean standards, but you're talking maybe a few hundred million to, maybe the mid tens of millions to hundreds of millions of U.S. dollars. The guys that can get into Korea, the institutions aren't interested because they're not going to make a difference. And the smaller investors, let's say in the U.S. or somewhere else around the world, could get access to those markets, really don't have access to it either. So it's an interesting situation where you've got a closed market that at some point will hopefully be more open, and you can get that capital flow. I mean, it's interesting, and that's the only country I've seen where that's sort of the case because of the constraint where you basically are, these types of businesses that if these businesses that we're finding in Korea were in the United States or even in Western Europe, their values would be a lot higher because there's more people like us that could invest in them. But I think Korea is the example that I can think of, but I'm sure there's other sorts of markets that are similar where basically, they haven't evolved that much. But I agree 100%. I mean, what I find is really interesting is just in Korea, even the special situation stuff, like I mentioned before, has done relatively well. There's holding company transactions in Korea. There's still this preferred common discount that's there. There's something interesting that's happening in Italy, which isn't quite as favorable as you want, but in the saving shares versus common shares sort of transitional issues. But there's still businesses over there that are trading at really really attractive prices through the savings shares. So I mean, I think it's an interesting market, and it's a very wide world. And basically, I think what's interesting is you can apply things. Let's say that you could say look at and apply the small caps or large caps in the U.S. to some of these other markets, and it's just a matter of, as Dave said, it's just a matter of having patience as the countries evolve and more capital comes into the countries and is invested as the markets in essence become more world markets as opposed to country specific markets, which is sort of where they started out. So, but yeah, no, I agree. Dave.
Yeah, Dave mentioned obviously the political ramifications. Sometimes you can get this major volatility overseas, and here we are a couple weeks away from an election with major ramifications on policy issues here, depending on what happens with both the administration and the Senate primarily. So it'd be interesting to kind of hear some thoughts on your thoughts on if you're doing anything to position for that, what you're looking for and observing. And I'm happy to kick it off with the idea that I actually think the biggest issue here is corporate tax increases. And I'd be very surprised if Biden is elected and the Senate changes. I think you're going to see most of those kind of economic policies reversed. And for me, I still own some companies with significant tax loss carry forwards where the value of those the last few years since the corporate tax rate declined, those companies were a little less valuable in that way. But then again, the overall market seems to have benefited from these corporate tax rates. And the decrease over the last few years, but there's so many moving parts here in the machine. And then what's the Fed kind of counterbalance as well, and those reactions and actions. So it's difficult for me personally to know how to play that, other than to say that I actually probably a little bit more interested in corporate reorganizations, company-specific things, special situations, as Keith discussed. I'm a little more U.S. oriented though, and I would guess that the value of my NOL companies would probably be reflected in the market to be a little bit, that value would be a little bit higher, depending on the specifics of whatever tax package comes about from if there was a new administration in the Senate. But Shri, any thoughts from your perspective, and anyone else here on the panel?
Right on that topic, I recently wrote about some of the lessons learned from earlier this year as it leads into the upcoming elections. And in fact, I make a couple of observations in that letter. One, Invesco had released a 12-page presentation material where they talk about how beginning in 1896 till today, somebody had invested in the market. A $10,000 investment would have become $7 million, versus being invested just in the Republican administration or in the Democratic administration would have not even crossed $1 million in more than 125 years. So the point being, it's better to be invested rather than make peripheral adjustments. Number two was this Warren Buffett's own comment that during his investing horizon, he's had more than half the time a president that he did not vote for, but that didn't keep him outside the stock market. So great lessons to sort of somebody like me who takes a fairly long-term approach, and also I'm a little bit more global. And as the opportunity set sort of moves around, I'm able to redeploy into some of these interesting markets. So my takeaway is just remain patient. In fact, I keep getting my entire portfolio is run through Interactive Brokers. I keep getting emails from them saying, because of increased volatility, expected increased volatility due to this upcoming election, they're increasing the margin requirements, stuff like that. Essentially inducing people to trade more, and so I'm taking the other side of that argument, staying put. I like the portfolio businesses that I'm partnered with. I'm not doing anything at this point.
Yeah, I mean,
excellent point. Invested, Keith.
Yeah, I mean, I think for me, I think the underlying theme of companies in the U.S. and around the world is the economic machine going to basically be throttled or disabled as a result of the election. And in my mind, it's not. I mean, it's not. I mean, when you look at the policies even that Biden is talking about, his worst case policy is, okay, we're gonna maybe increase some tax rates on some people that make a lot of money and on businesses. I mean, if that's the worst, that it's not going to cripple the industry, and it may. I mean, an interesting implication of that is that, you know, if you look at it from an international perspective, is that if rates go up in the U.S., there may be some, you know, more attraction from international kind of stuff. But in any case, I think that the economic engine is still going to be running, and I think that's sort of like what Buffett talks about a lot too. As long as the governments don't muck with the economic engine a whole lot, I think the results are, you know, if you look back in 20 years, I think you'd say, okay, you still want to stay invested. You wouldn't want to go to cash or do anything like that because the opportunity cost is still gigantic. So, as all the managers are doing here, if you could find a good set of what you think are growing businesses that are selling at a discount to intrinsic value, and managers that are willing to stick with that until intrinsic value is realized, I think that's the key. That's sort of like Graham's initial, you know, his initial thesis and the way he thought about things. And as long as you're sticking with that, I think that's key. And one of the things that you probably don't want to do at a time like this is to switch strategies, going from one strategy to another, because inevitably you're gonna miss it, or there's gonna be something that's not quite right, because strategies have a tendency to be very cyclical. You know, the growth strategies work for a while, then the value strategies work for a while. And so if you want, from a long-term perspective, you want to basically be in the market when your strategy is doing well, and you have no idea when that's going to happen. So in my opinion, the best way to do it is just to be fully invested all the time, and just let it happen that way. So.
Well, not just in your opinion, but as we heard from Shri, historical fact as well.
Yeah.
Dave?
Yeah, I would just caution anyone who is too certain about where the market's going to go, no matter who gets elected. I mean, on the night we found out that Trump won the presidency, if you remember, S&P 500 futures were down something like 6%
Right.
in the middle of the night, and yet they actually closed up the next day. Or maybe it was the Dow, but anyway, a major index panicked, recovered everything, and then changed just a little bit above unchanged for the day. And so, yeah, I don't think anything, well, not anything, but I don't think anything that either of these potential presidents are proposing can stop the heart of the American economy or the world economy, because people will continue to work and work hard and innovate and invest. And there can be better and worse conditions for that to happen but it keeps on going. That's just that's the human spirit. And so, sure, maybe the next year is volatile or up and down depending on policies and proposals and the fights that go on in Congress over those. But yeah, but I don't think it necessitates anyone reconsidering a well thought out strategy.
Yeah, I remember the evening when Trump did get elected. I remember the Dow was down 700 points. I was in California at the time, and it was about 2 in the morning, 3 in the morning. I was up watching CNBC, and Carl Icahn made a comment or went on or had a radio or a phone interview or something, and he said, "I'm going to put $1 billion to work the next morning." And by the time the markets opened the next morning, they opened up. So, you know, we were down that 6%, as Dave mentioned, overnight. And I actually had some hedges on that I was very excited about at that particular time, and would have been very profitable. And then the market ended up opening up. I didn't even have a chance to cover them. So, yeah, I would. What's the old quote that he who relies on the crystal ball eats crushed glass? I think that's what we have to look at in this situation, because the economic machine is so complex and there's so many levers. And certainly the Fed has an opportunity, an outsized role in today's market as well. You know, talking about these themes, I think this is a good one for Keith to start off on. You know, industries, markets, themes. What are you looking at right now? What do you see as some of the potential winners and losers from a company perspectives?
Yeah, so I mean, I think I've focused on interesting themes. An example, let me give you a specific example. We talked a little bit about this, car retailing, okay? So, and this is a good example across a number of things. You can sort of see how various economies actually react to changes in what's going on in terms of COVID recovery. This is an example of, okay, China and places in the Far East have had COVID recovery faster than the US. So you can clearly see one of the best car dealerships over there is just sort of taken off. And so you've really seen, okay, it's recovered, it's higher than it was before. Now you come to the United States, we're maybe in the next group of countries that would deal with the resolution of that. The United States is, the car companies are about even. Then you go to a place like England, they're going to be further behind, or Europe just from that perspective. And then South Africa, which is almost the EM situation where it's really been hit hard. But I think from a theme perspective, what's interesting about this time is usually what you'll see in those types of themes is you'll say, okay, what worked in the U.S. and we'll see if we can apply it to some other foreign country. What's unusual about this case is we can look at what happened in China, which in essence is sort of an maybe emerging or developed market, and then compare it to the rest of the world. So I think that's a way you can think about the economics of the various businesses, because different countries are in different phases of dealing with COVID. And it's interesting, I think you can sort of see what's going forward if a country is successful with it. And there's a lag, and you can actually see it in the stock prices of various businesses. Now, it's not only just in car retailing, but in other types of businesses too. I think you can see the lag that's happening over time. And over time, if things recover like they have in China and other places like that, then you should be able to take advantage of that lag. So I think that's an interesting theme I think I've seen sort of work out now with auto dealers, but it's applicable to other types of businesses too, where now, historically, I don't think we've had examples of major groups of economies that you could really do that with. And this is really the first time you can do that. I think it's an interesting way to sort of think about businesses and recoveries and prospects and stuff like that. So, I mean, that's
Right. Yeah, it's almost the reverse, because historically you could say, well, if I'm looking overseas, I can see maybe an industry or a particular company's strategy applied, in a foreign company,
yep.
and see how they can take over. And now we're actually looking, opposite, as you indicate. Dave, Shri, any thoughts?
Yeah, for me, I generally, like all of you, my analysis is more bottoms up, fundamental analysis, looking for interesting business models, people running it, and stuff like that. But given the way you sort of posited the question, I'll say a couple of things. Right before my business school, University of Chicago, I was working for Principal Financial Group, a pension-focused company that sort of the market leader in 401k. And as a part of that, we opened up offices in a number of different countries. And in that exercise, a couple of observations came out. Countries like Chile and Singapore, which were able to, reorient their pension programs, were able to improve the infrastructure and, as a result, the overall economy. There's a slew of books and papers written about those two countries. And I only bring that up in relation to a couple of newer opportunities that have come my way. Again, I go back to Poland, and the other country that is going through a sort of a pension reorientation is Australia with its superannuation. Let me refocus on Poland. In the last couple of questions ago, David mentioned about some of these interesting countries which may not necessarily have certain governance policies in place. This is a fascinating country. In the last 520 years, the country has been independent for only 52 years. It is obviously not the first country you would think of when you think about capitalism, free market capitalism. But over the last 30 years, if I asked you, name the two countries that have had the highest GDP growth, you probably will turn around and say probably South Korea. What's number two? It's actually Poland. It's been a phenomenal growth story in that regard. Governance is more indicated. They kind of replicate what's happening in Germany, and so it's comparable to a large extent to the Western world in that regard. They follow, from an accounting regime standpoint, IFRS, International Financial Reporting Standards. And most interestingly, the country is highly educated. And in fact, as we speak, the tech talent in the country is phenomenal. Most of these gaming companies that you see in the Western world have a presence there only because the tech talent is fantastic, both in Warsaw as well as in the south central part of this country called Wrocław. I'm absolutely mispronouncing the name. Unlike Indian names, you have a lot of vowels and consonants that you don't pronounce. I don't mean to be disrespectful of Polish people, but that's the best pronunciation I can come up with. So it's a fantastic market. If our job is to be able to look around the corner and see where the next opportunity is, I see Poland as a great market. Fantastic entrepreneurs who have the same kind of urge to, make money, do well, and very honest, be very honest up front. I speak all that from Chicago, and Chicago is the largest Polish population in the world outside of Warsaw. So we have a specific holiday for Chicago schools based on a Polish
Pulaski Day,
individual.
yes.
Exactly. So it's a great market. I'm continuing to work on. I already own one. I'm continuing to work on Poland as another opportunity. And as I said very briefly, Australia is another market which is going through a pension reform. Superannuation total asset base has already grown into 1.7 trillion. And I saw Morgan Stanley come out with a report saying over the next 5 to 10 years, they see that pool of money growing to close to 7 trillion. So a lot of tailwind in that regard. The locals, both retail and institutions, refocusing their efforts into those economies is going to be a tailwind for managers like us finding opportunities. So that's where I will end my comments.
Absolutely. It's very interesting. Dave, anything to add?
Sure, and I'm really great stuff from Shri on Poland. I'll definitely have to follow up with you. We can compare notes and a couple opportunities we're seeing. That'll be good. But an area that appeals to me,
services, I think he might have a local by him who can help to translate some of the reports there, which is positive.
That could be incredibly helpful. I'll definitely follow up. But something I'm looking at right now is small banks. I think are incredibly interesting. It seems like every few years, once or twice a decade, the market collectively decides that small banks are dead and they'll never ever earn their cost of capital again, and they should be traded for way below liquidation value. And some of them should, some of them are just bad. But with COVID, you had a double whammy. You had, first of all, loan books getting a bit of a challenge because, anything loaning against a hotel or really any is probably pretty challenging right now. And then you had the Fed taking interest rates down again, and it's really hard to make money when the 10-year is at 75 basis points or whatever, and the curve is so shallow, really. But if you look at the stats, you can see that small banks are actually a larger percentage of them trades below tangible book value than did just after the financial crisis, which is incredible. A lot of these banks, in fact, nearly all of them, came into 2020 far better capitalized than they did into 2000 and 2009. And so survival is not actually in doubt for nearly all of these institutions. And I think that at some point we'll see a rewind of what we saw in 2015, 2016, because back then you had all these small banks trading at these really low multiples of book value. And all it took was 1 or 2 interest rate hikes. And some of these banks are up 70, 80, 100% in the next 12 to 18 months, just on a view toward a more normalized profit environment for them. And so these banks, they know how to get through a period of low interest rates. A lot of them added services, whether it's mortgage banking or trust and wealth management, or became SBA specialists, whatever they did to add service revenue and become less dependent on net interest income. And so they know how to get through it. And someday interest rates will get back to, maybe not normal as we see it, but something other than zero across the curve almost, and profits will roll in. And so I think patronizing small banks that have good leadership, have a good time operating in a good market, and have the opportunity to take market share during this time, and can make money even in this environment, because it wouldn't take much of a tailwind from the Fed or from interest rates in general to really increase those profits. So I think that's a fun place for me to look right now.
Yeah, great.
I mean, the interesting thing about banks too that I've noticed is, especially as Dave said, amongst these smaller banks, you have some that are growing incredibly fast, have really low efficiency ratios, so in essence they can continue to grow fast, but they're selling at like 10 times earnings. You have banks that are growing in the mid to low teens growth rates at 10 times earnings. You never see that. And these are banks are in these little niches where they have a very good lending franchise, where basically these guys, the big banks don't want to deal with them because it's just too small for them to even think about. And it's just incredible just the way that these small banks are really being thrown out with everything else. I mean, clearly, I think in some banks, there are real issues there, but if you're very selective and know how to really look at them, I think there's a great opportunity in that.
Yeah, and I think we'd all agree too that we should give a shout out to Nate Tobick at Oddball Stocks and his great bank analysis and things like that. So great points. Final question. Defensive fundamental investing. So the setup here is kind of an interesting interview recently that Joel Greenblatt did on Barry Riddles' podcast. And he made the point that if you bought every company that lost money in 2019 that had a market cap over $1 billion, so every company that lost money in 2019 with a market cap of $1 billion, if you had a basket of those companies and you owned them in 2020, 261 of these companies, collectively that basket would be up 65% this year. So clearly that shows an issue with the idea that the income statement, some sort of multiple of earnings or free cash flow actually matter in this environment. So is fundamental investing dead, or is it just temporarily suspended? Will it return? Shri?
Yeah, it's a regular question that we all come across in podcasts like this. I absolutely don't think fundamental investing is dead. In fact, it is a great opportunity for managers like us to separate the wheat from the chaff. Particularly so in answering that question, I think it would be important to step back and ask ourselves, what are we doing by creating these portfolios? What is valuation? If valuation is essentially a discounting mechanism of future cash flows, fundamental analysis will help us think about separating some of these, growthy, tech-oriented, and beneficiaries from this kind of an impact from something like a regional mall or an energy company, things like that. So no, I absolutely think fundamental analysis is here to stay, and it is a big beneficiary for individual managers like us, active managers like us. It's just a matter of, I think, taking a perspective on, various different factors to underwrite. So one of the things that I did not have in my pre-mortem as I was investing pre-COVID was, what happens when countries around the world go into a total lockdown. Obviously, that is a new underwriting criteria that I've added to the list. But in spite of going through the February, March pullback, I do think sticking, from my standpoint, sticking to the mantra of quality companies, quality balance sheets, quality management teams available at a reasonable valuation is a great way to kind of create wealth over time.
Yeah, absolutely. Keith?
Yeah, I mean, I think listening to, like you're saying, to that podcast, also Joel Greenblatt also mentioned that the companies that are the most vulnerable are basically the ones that aren't there. They're sort of They have models that are like these great businesses like Facebook and Apple and Google, but they're the next tier down trying to be those kind of companies. And you can see that even now. I mean, there's some companies that they miss their forecast by like, a few cents and the stock's down 30, 40%. I mean, and those kind of businesses, I think in my estimation, the Googles, the Facebooks, those are very rare businesses. And a lot of companies are being valued as though they're going to be the next those, which they probably aren't. So it makes it much more challenging from that perspective in terms of. So I think what's going to come back, as Shri had mentioned, and you also mentioned, Steve, is basically looking at the fundamentals of the business. And in the end, I think all businesses are going to be internet businesses, and it's just a question of how the business is going to adopt the internet for their existing model. And businesses actually that are internet only actually can be at a competitive disadvantage. So, for example, look at like automobile dealers. The internet only guys, they only have one way to monetize their customers. That's through internet sales. However, if you look at online or an offline dealership, they have multiple ways to monetize that customer. So it's very interesting how the market will place a lot of value on, let's say, an internet only auto retailer, and then the ones that aren't, under the assumption that somehow they're going to basically displace all these online retailers. But I think the offline retailers have gotten smart, and they're actually adopting the internet as part of their package they're providing to customers. So their actual value proposition to the customer can actually be greater than an internet only provider. And so in the end, if that's the way the market's going to play out, these internet only guys are either going to have to merge, or they're going to be at a competitive disadvantage to the online guys.
This is AOL taking over Time Warner situation. Dave?
Yeah.
I mean, obviously, no one here believes that fundamental investing no longer works, or
Come on, this is a leading question.
jobs if it really doesn't work, because oh boy, we're going to have a tough decade ahead of us. I will say I don't think that it's gone, but it changes. It's always changed. I think that a lot of traditional value investors have struggled in an environment of rapid change in business models and a rapid change in consumer behavior, and then throw in gigantic political and epidemiological issues, and here we are. A lot of investors probably have relied too much on reversion to the mean, the idea that, oh, a company just having a bad couple of years and they'll snap out of it, they'll get back to it, when it really could be that a new competitor came along and ate their lunch and took their customers and they're in terminal decline. When you saw that with Sears Holdings, so many very, very intelligent, accomplished value investors held Sears for years and years because they were anchored to a value of the real estate that just wasn't there. Those properties were just not worth what they said they would, and then compounded with the outgoing cash flow from operations, it was a death spiral. So that's incredibly important. And also, I think another factor that's has allowed some of these companies, loss-making companies that you highlighted, to do so well is, well, capital is cheap and endlessly available anymore. I mean, historically, a company that did not make money, that was cash flow negative, they had the runway would end eventually. They would burn through their cash, and any subsequent capital was not available on terms that were feasible or at all when you're paying 8, 9, 10% for debt, or equity investors have the alternative of earning 5 or 6% on treasuries. Their patience is much more limited than now, where you could roll out another billion or two to a startup and maybe make 10 or 20 billion, or you could make 10 or 100 million on treasuries. It's an easier decision to keep on bankrolling that loss-making company when your alternative is making probably less than inflation in risk-free investments. And so, yeah, investors who expect a short-term, quick return to earth for some of these companies might have a disappointment in mind, because a lot of these companies, if they're anywhere close to break even, can roll for years and years and maybe bootstrap themselves into something viable in the end. And so I caution anyone who goes and wants to just hears that these companies are up 65% and says, oh, it's a great time to short. I'm going to buy a whole bunch of puts and short stock, and that might not go. I do think that identifying the companies that are fundamentally sound and fundamentally can adapt to the new business environment, as Keith was talking about, the returns will be there, even if they take a little while to come around. They will show up.
The final point, we still matter. Our analysis still matters. Shri Viswanathan, David Waters, Keith Smith, thank you for being here and joining us for Willow Oak Asset Management's third quarter review, and best wishes for the rest of the year.
Thank you.
Thank you.
You too.
Thanks.